this is a very dangerous setup, and it may continue to be for 2 more years. I mean, it's not possible to know when the passive bid will get swamped by enough bad news, or the balance of the passive bid in terms of the money going in versus what comes out can get diminished enough to allow the fundamentals to matter, or if we at some point will see the passive bid start redeeming. I mean, if that were to happen, it would be absolute chaos. So you have to be aware that it's a very dicey setup. It'll be hard to change it, but if it changes, things could get ugly quickly.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. It's a tricky time for investors right now. We're seeing increasing signs the economy is slowing down, but nearly all assets are surging in price right now. Some, like many stocks, are at all-time high valuation levels, even though the weakening economic data increasingly makes their forward earnings forecasts look less and less attainable. Bond yields remain elevated and inflation is not yet at the Fed's 2% target. Yet it seems highly likely that an interest rate cut of at least 25 basis points will happen this month. So what'll win out from here as we head into the end stretch of 2025? Will the momentum and investor exuberance keep driving asset prices higher? Or will they finally start to buckle under the gravity of the underlying data? For answers, we've got the great fortune today of turning to veteran money manager Bill Fleckenstein, founder of Fleckenstein Capital. Bill, thanks so much for joining us today.
Nice to be back, Adam.
Well, Bill, it's great to have you back on a beautiful day in the Pacific Northwest. I'm glad you guys are still having a great Indian summer there, as you mentioned. Lots to talk about. I went back and reflected on our previous conversation from a few months back, and a lot of the questions we were raising then, we have more answers to now. So very interested in getting your latest update here. If we can, let's start at the market valuations. How concerned, if at all, are you by the disconnect that I mentioned between today's elevated and still rising asset prices versus the slowing economic data?
Well, the problem is that valuation means almost nothing anymore, because the the driving force in investing in the market today is the passive bid. And given its market share at roughly 50%, and then all the people have reverse engineered what appears to have worked, you have a smaller subset of people who are actively trying to look at securities and look at the fundamentals and try to weigh them, right? I mean, the market is 100% voting machine in the short run always, but now it's the voting machine aspect is entirely what moves the market. And that's why incremental flows seem to help on the upside. And that's why so many people are focused on flows now, because it seems it is currently working. It's not that the flows necessarily, from a logical perspective, or why would work in a period where the market wasn't as dominated by passive, but that's what has worked. And so the valuations mean literally nothing right now to the market, to the system, to all that. It might matter to you and me how we run our money, or it might matter to people who try to manage risk. But if you're a professional, that's been a dangerous thing to do, because if you try to use your good judgment as to what to do, you get left behind by the passive monster, and then people think you don't know what you're doing, and they take the money away, and then the process continues. And so that process is still underway. It's been underway for the last group of years. Every time we've spoken, it's bigger and more powerful than ever. And you have to be willing to hold two thoughts in your head. One, this is a very dangerous setup, and it may continue to be for 2 more years. I mean, it's not possible to know when the passive bid will get swamped by enough bad news, or the balance of the passive bid in terms of the money going in versus what comes out can get diminished enough to allow the fundamentals to matter, or if we at some point will see the passive bid start redeeming. I mean, if that were to happen, it would be absolute chaos. So you have to understand, as Mike Green said so eloquently the first time he explained this to me, you have to know the rules of the game that you're playing. You can't think the rules are one thing. You have to know what the rules are. You may not like them. So you have to be aware that it's a very dicey setup. It'll be hard to change it, but if it changes, things could get ugly quickly. If the bond market were to get weak enough, that could matter from a balancing standpoint of the passive, balances in portfolios. They try to keep them, if you're 90-10 or 80-20 or 70-30, they try to keep them in line. So bonds got weak enough, like we saw in 22, or was it 22 or 23? No, I can't remember exactly. But then that
It
could
was 22 when they started the
22,
week.
yeah, that's right. So that could matter. So those things can matter, but right now none of that's working. Even though I could argue that the bond market has begun the process of taking the printing press away from the Fed. That was always been a theory of mine that eventually would happen. And, it's been a year now, but, and let me see where did I put this. I looked at this morning. So in the last year, leading up to the last FOMC meeting, short rates are down 100 basis points. And while 3-year rates are only down, call it maybe 25. So the biggest declines have been at the short end. Once you get out past 7 years, rates are actually higher. So I think you and I talked a couple of times since those rate cuts began last year. And I said, well, it's, the bond market has done the opposite of what the
Right.
Fed has done. And people made up a lot of rationalizations why it didn't really matter, and I didn't know whether it would or wouldn't. But here we are 1 year later, and that's the case. So when the Fed cuts later this month, it will be really interesting to see what happens if the bond market continues to not like what the Fed's doing. That's going to be a sign of real trouble, because rate cuts will make bond rates go up perversely, and that'll be a different regime than any of us have seen probably since the 70s. Um, um, so, but we have to see how that starts to play out. I mean, maybe they cut rates and long rates fall. I mean, my theory is the process has started, and but it hasn't done much damage because of the passive bid. What it started out with. So anyway, I think this upcoming FOMC meeting is going to be really interesting to see how the market responds, the
Okay.
the bond market.
And let me ask you this. What are you expecting at the next FOMC meeting? A quarter basis cut?
I don't know. They'll cut. I don't know. I don't pay
Okay.
attention to that crap. I mean, who? I mean, you know, they're going to cut. So
Okay.
whether they're 25 or 50, I mean, I don't know.
Okay. But you think they're going to cut, which the
Yeah,
majority of the market does too.
yeah.
All right. So a lot to react to there. And look, I totally get it, right? We've got this passive capital flow juggernaut, right, that just crushes everything in its path, or crushes anybody that tries to fight it, right, and has done so for a long time. So you got to be very cognizant about trading the market you have versus trading the market you wish you had, or think we should have. Um, Let me ask you this, because you've said, you know, that trade, yeah, that's going to work until it stops working, right? And I totally agree with you. And it's dangerous to jump in front of that and try to time tick, the actual ending of those that juggernaut or the
Well,
giant mindless.
what you can't do is you can't really anticipate it. You can look for signs that something may be changing, and then try to act. But to just say, to pick a spot and anticipate the change is really, I think, asking for trouble.
Yeah, and I think there's been years of enough uh, bodies on the highway of folks that tried to do that we know, okay, look, that's a very dangerous kind of reckless thing to do. So let me ask you this. So um, that'll continue until at such point it likely changes. I mean, I guess it could go on forever, but I don't think
No,
that
that's
that's
not gonna happen.
likely.
No.
Um, as I mentioned in the intro, the economy, we're starting to see increasing signs that the economy is slowing.
right?
In your mind, when does that become material enough to perhaps impact the trajectory of that juggernaut of the giant mindless robot?
I can't say. It has to do with employment, and I don't know. I don't know that there's a direct link between, X amount of GDP growth and just the right amount what the amount of job growth needs to be. Because there's the other variable of, what if people that are retiring take more money out, right? So there's both sides of that equation. So
Right.
I don't, it's not anticipatable,
It's not, but I guess my question is if the economy starts slowing, and let's say it starts
well,
slowing enough where we start seeing indicators that we normally associate with recessions, including the unemployment rate starting to materially move higher. And
mhm.
it's beginning to nudge to, but we're not in that danger zone yet, but we could be if current momentum continues. Could that be something that eventually, if it got big enough, could
Yeah,
actually
I
stop
think
the
if we
juggernaut?
we start to see, you know, unemployment, or sorry, employment really slow down, or to see more jobs lost, any of those kind of things, that'll really matter. You'd have to ask Mike if there's some sort of precise formula, but I doubt that there is. It'll just, I don't think it's knowable in advance what level of GDP growth triggers what level of job growth triggers a diminution in flows that is going to matter, right?
Right. And I agree with you, and I'm not trying to push you for like the magic formula. The question I'm trying to ask is, are we potentially seeing enough risk factors to make somebody like yourself who studies the passive capital flows say, hey, I could see this thing maybe turning at some point in the future if these trends get worse. And let me just name a couple of them so you can react to it. We've got consumer spending that is, I think, best described as anemic right now. We're seeing lots of, debt delinquencies spike, and that leads to, debt defaults at some point in time along the consumer debt spectrum. Similarly, on the corporate debt side, we're seeing, we're getting into the heart of the re-rating of corporate debt, right? Where the debt on corporate balance sheets is now coming up for maturity, and it's having to be refinanced at substantially higher rates. We are beginning to see a real uh, uh, worsening of the employment market. We just had the kind of a string of bad economic reports last week. Unemployment rates starting to tick up here. And we have a housing bubble that seems to be in an increasing number of states in the process of bursting. So collectively, could those things get to a point where they could really impair those capital flows, those passive flows?
Well, the only thing that matters is employment growth vis-a-vis the passive bid, job growth or not enough job growth, right?
Hmm.
You're talking about factors that impact the economy. And I agree with you, the economy is slowing, and there's all kinds of troubling bits of data that normally would probably have caused the market to start to anticipate trouble. But the market doesn't do that anymore because of the passive bid.
Right.
So it really gets down to employment. What is the it's not about sentiment. It's not about the human nature aspect of the market. It's purely mechanical. How many dollars are going to get sent in this week, and what's going to change that?
Right.
Fewer people entering the workforce where they're getting that kind of retirement compensation to go with their regular compensation.
Right. Or a contracting workforce, which,
Well,
according
yeah,
to the
well,
latest payrolls numbers, we're not that far from.
yeah, yeah, but um, it depends on the remember the data that we see from the BLS is
Wicked imperfect. And
yeah,
that's being charitable.
got the birth death model, and all. The birth death model doesn't impact any flows. It's all imagination, right?
Yeah.
It attempts to capture business formation. And everyone who's paid attention knows that it's always wrong at the turns. So it's possible that the employment data is already weaker than it seems vis-a-vis the passive bid.
Yep.
But it's not like it's not like the national debt clock where you can watch it go up every second, right? It's not, there's no, it's not, the data doesn't exist like that. I mean, I don't have the ability to track that stuff. I don't feel like I'm going to be able to figure out exactly when it's turning. You'll be able to see it in the tape. I mean, you're not going to anticipate a top in the market, which is always impossible, always hard to do, but one that's inspired because this variable is shifting, which is a monster variable. I don't think you're going to be able to anticipate it. It will have to make itself apparent. And we had a nasty sell-off last spring, and part of that was because the news got bad enough when some of the other factors, sort of the pilot fish that go with the passive bid, these mechanical strategies were kind of fully loaded, and maybe the passive bid was only a certain size, and we got all the bad news on the tariffs and all other stuff, and the thing fed on itself, right? We broke through the passive bid, and the thing fed on itself, and then the market righted itself. And now here we are, and the passive bid's totally in control once again.
Yeah. So where I'm trying to go with this, Bill, and I'm not trying to sell doom. So if you disagree with sort of what I'm saying, again, please just be real clear about that. What I'm trying to say or trying to ask is, oh, okay, you could on one hand you could say, you know, let's just learn to love the juggernaut and just, invest with what's working, right? And you can just say, well, you know what, I'm just going to be long because this juggernaut is unstoppable, right? There's that side of the spectrum. There's the way other side of the spectrum, which is I think this thing, is going to stop tomorrow and I'm going to jump in front of it now. And you've said, hey, that's really reckless for, all the dead casualties we've seen over the past bunch of years of that. I totally agree with that too. There's kind of a middle ground where you could say, hey, look, I think the market is sending false signals because of how much the passive bid is overwhelming everything. But the fundamentals are hollowing out because a lot of the things I mentioned on my list, shrinking corporate profit margins, anemic consumer spending, a worsening housing situation, stuff like that, increasing in consumer debt defaults and things. Those are all things that are basically translate into tighter corporate profit margins and eventually layoffs, right? To your point, it doesn't matter until it impacts the employment market. So if you have that concern, you could say, hey, look, I'm not ready to jump into this, to bet against this market yet, but I'm not going to be screamingly for it. And I'm basically going to be kind of maybe building up dry powder and being positioned so that if indeed that stuff does eventually start to win out, I know how to move. Which environment do you think is the most, or which stance do you think is the most appropriate for this environment?
Well, well, to say, well, it's worked and therefore it's going to keep working and therefore I don't care about any of these risk factors, it would be rather foolish. So I think that it's more important to you have to figure out a way to uh, be able to, not like I'm trying to participate. You have to make individual stock selections that you think can do well regardless of the period we're going into. And you have to be mindful of the fact that there's this enormous amount of risk out there in the form of what if this passive thing starts to reverse at some
Mm-hmm.
point. So you have to figure out how you want to manage that risk. I've tried to find securities that I think can do well regardless of the economic environment, stagflation, inflation, recession. I think I have securities that won't be impacted by that given where they are. Um, and then I want to hold cash to offset the risk of the unknowable. Just that's what makes it easier for me to sleep at night, right? Everyone has to make that decision, but you have to know that if you're fully invested right in the wild animal, that there's going to be a moment in time when things change and you'll have to have a plan of what you're going to do and what you're looking for. I can't tell you exactly what to look for. I know what I think I'm looking for, but again, you're just going to have to respond to the fact that it seems like things have changed and there will maybe be some data. maybe Mike Green will be nice enough to stand up and say, okay, everything's changing, guys, batten down the hatches.
Yeah.
We'll see.
Okay, but thank you. You just actually provided the answer, the type of the answer that I was looking for.
Okay.
And specific, so, you are, I would say you built up a fair amount of dry capital in addition to your cash that you mentioned. I know you've also been in the precious metals and in the miners. Those have done quite well. I want to ask you about
Yep.
those in a moment. You talked about your companies that your targeted companies you're picking that you feel could do well in almost any environment. I think the last couple of times we've talked, you've called those your rifle shots,
Right.
right? And as an example, can't remember the name of the company, but I know one of the examples was sort of a biotech company that
No, Pure Cycle, not biotech. I talked about Pure Cycle last time, I think.
okay, I think you are correct. So maybe I'm forgetting, but basically it's a company that if what comes out of the lab does well, it's going to have a step function in its valuation, right?
Well, it's like a biotech in that sense, and I have had a couple of biotechs, so I mentioned those in the past. But Pure Cycle recycles polypropylene, of which there's way too much in the
Way
world
too
now.
much in the world.
That's
Yeah.
why we can't use paper. We have to use paper straws here, and you have to use paper straws there. So anyway, they actually can actually recycle and take post-consumer polypropylene and turn it into virgin polypropylene. But anyway. So that to finish the thought on that idea, that's that one.
Okay, great. And I'm not, and I know you kind of went deep into that company last time. And folks, if you're
Right.
interested in learning more about it, go listen to my last interview with Bill. I'm just trying to say these are companies that they're working on something that isn't tied to whether we go into
Right.
inflation or
Yeah.
deflation, right?
Right.
Yeah.
A biotech, if you had this, that those kinds of companies, or this one, or a couple other, yeah, those kind of companies that aren't dependent on GDP growth. That's
Right.
what
If you
one.
come up with a cure for cancer, it doesn't really matter what GDP does. The world's going to beat a path to your door.
Exactly. So you need to find idiosyncratic companies that can grow in any environment and can keep their margins up. It's another, and so there's only a certain kind of companies that can do that. And of course, just because you pick one because you think it can do it doesn't mean you'd be right either. But
Right,
anyway,
right. And I'll give you a chance at the end to direct folks to it. But if you want to kind of get an idea of where some of these companies, what some of these companies are to go investigate, subscribe to Bill's letter, and you can see, get visibility into his mindset on this going forward. All right. So, Bill, again, I mentioned a bunch of factors there that are contributing to the slowing of the economy. I'm just curious, what's your outlook on the U.S. economy? A, do you agree that it's slowing? And B, how much do you think it may slow over the next year?
well, I think it's not debatable that it's slowing, and there's a lot of cross currents. It's particularly unusual to have young people coming out of college having as much difficulty getting jobs as it appears is going on now. Particularly, it seems like, it's not just somebody who had a poli-sci degree. It seems like some of the kids in STEM, are also having trouble. So that's a little bit disconcerting and a little unusual. A lot of that is blamed on AI, but based on what I've read, I don't know that it's really had as big a factor. It has been as big of it's been AI has been a scapegoat for that. I don't think it's really been the reason, I guess. So the economy is kind of muddling along. It's worse probably than it was a year ago. We're going to get some more rate cuts, which may help. Although if longer rates go up, that's not necessarily going to help the housing market, unless you want to finance via an arm. So I think the economy is going to be kind of in a weak stagflation at best, and probably a little worse than that. I don't think there'd be a lot of economic surprises on the upside in the next year, but who knows? I think it's just going to be kind of uninspiring economic environment for the next year.
Okay. Um,
More inflationary pressures, more things like that, more negative developments than positive.
okay. And I know that you have leaned towards stagflation in our past recent conversations. Could the economy slow so much that you stop worrying about the inflationary impulse?
No, I mean, come on, we're 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 going to have Trump's going to have four people running the Fed probably within the next, what, 6 to 8 months. And they're gonna lower rates, and they're gonna lower rates as much as they think they can. And if that doesn't work, they'll probably go to yield curve control. So I'm not going to start borrowing trouble. I mean, you normally when you're looking into the kind of rate reductions we might see, that's normally when you would think you're in a recession. In the
That's
past,
why I'm asking the question. Yeah.
yeah, but remember, and stocks would have gone down, and that would have reinforced that, and we would have had a whole cycle. But now stocks didn't go down during that part so far during that part of the movie. So then, if they just throw more gasoline on the fire, who's to say that we don't have another leg blow off to the upside? I don't know, and I think if it's that's why I say it's really dangerous to have a strong opinion about what can't happen, you know. And so you're going to tell me if, let's say they wind up cutting 50 basis points.
Hmm.
In the past, they never cut rates when stock market was doing as well as it's been doing in the last, we've already had four cuts now. This will be five, since they started. No, three. We had three,
Yeah.
50, 25, and 25. And this will be the fourth. But there's no major sign of trouble through any of that, right? What bad thing happened other than, tariffs and a lot of machinations around Trump and and his approach to things, and changing his mind all the time. But we got these rate cuts and nothing bad happened, right? Sure, the inflation rate dropped. The rate of gain of inflation going up fell. So what happened? We had this huge increase in inflation related to COVID and the money supply, monetary madness and fiscal madness.
Yeah.
And now,
And broken supply chains, but yeah.
what's that? Yeah,
And
yeah,
broken supply chains. Yeah.
all of that. But now we keep talking about the rate of change of this number that's way up here from that used to be down here. So this little dance around 2%, blah, 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 it doesn't matter. People have experienced this to this, and they haven't forgotten about it because this is not going back down there.
Right.
So the psychology, which I have harped about since before it started happening, has changed. And that's the thing that people don't appreciate. And if you had been around in the early 80s, you could have seen how this went. Volcker broke the back of inflation, and we had the stock market, this epic bull market began in August of 82. And the Fed lowered rates, but by 84, and the economy was growing, the bond market freaked out, and rates went back to 12%. Long rates went back to 12%
Yeah.
because they thought the Fed, we don't, well, all right, now we know inflation's coming back. We believed your BS at the Fed, and now it's going to be a problem. The bond market didn't believe the Fed. They thought the Fed was going to produce inflation again, and that was going to be a problem. But that didn't happen. And so that was the human psychological component that did that.
Yep.
And then for the next 30 years, people believed the Fed no matter how bad mistakes they made. So now we're in a situation again where the bond market may be about to has been for the last year kind of disagree with the Fed, and we'll see how that goes, right? So my point is people's psychology about being concerned about inflation is not because they care about whether next month is annualizes to 2, 2.1, 2.3, 1.8. They're worried about this huge jump that's never going to get unwound.
Yeah. So let me ask about that. So how do you get beyond that? Do people just finally get inured to where
Kind of,
prices have ended up?
yeah, but I mean, is that going to make them believe that inflation is under control or not under control?
Again, so my question to you, when do they start believing it's under control? Is it just a factor of time that they
I
hang
don't.
out at these new prices for enough
I don't
years?
think I don't think they will, because the policies that we're going to pursue are going to be pro-inflation. I mean, I know that if the asset markets break, that provides a deflationary pulse through the stock market. But the Fed is going to be easing, and we're going to probably get yield curve control if that doesn't bring long rates down. And those things are going to make people are going to keep the concern about inflation up. And if the currency gets worse, gets weaker, then to the extent that, we import things, that might matter. Um, uh, but it's I don't think that the inflation cycle, I think it would take time for people to stop worrying about inflation. And you'd need a lot of these prices that have gone up and up and up to have to really roll back. And then maybe people would change their mindset. They may not be thinking that inflation is going to go from 2 to 10, but they might continually think inflation is the problem, and at the margin be worried about it, right? Once you've experienced a period like this, just like when COVID started, I said that the shortages might make people think differently about what might happen, because when you have shortages, then you have price hikes. So
Right.
people buy in advance, and those psychologies all wound together, and people aren't going to forget about it. It'll take time. It'll take time, and I think you'd need to see a lot of prices get rolled back really pretty hard. I don't see how that's going to happen, like insurance rate. I mean, there's a whole group of prices that are up substantially, and so I think that they would have to be unwound. I don't see that happening. I mean,
Okay. Yeah.
it could if
And
we had a big.
I don't really too. Now that being said, in some there are, right? We can look at eggs, we can look at the price of gas, we can look at things like that that are down a lot from where they
Not
were a
in,
year or two
not
ago.
in my state, not in your, not in Washington, not in California. It depends on where you live.
Right, but nationally, those have. I just want to acknowledge that we have seen some price declines in some of the staples, but in the vast majority and the vast average of people's cost of living, no, it's not getting dialed back anywhere near close to pre-COVID times. And Bill, look, I find your logic compelling, and I think sort of ceteris paribus, it makes a lot of sense to me. The question I'm trying to dig in, and I think I'm getting your general sense of it, is to your point about be careful about having too strong an opinion about any outcome. I'm just wondering how much of a door we should leave open to the fact that, like, hey, if we lose enough jobs over the next couple of quarters, um, could that potentially create a period of time where, um, you know, the economy slows, enough people lose their jobs, it disrupts the juggernaut of the passive capital flows. We have a correction in the market that then freaks out the system even more. And yes, the Fed is cutting into and all that, but those Fed cuts act with a delay. And so, could we potentially have and I'm making this up, but a start to the first half of 2026 where disinflation is really in charge, and then we don't return to a inflationary or stagflationary state until the impacts of the policies start to make them ripple through the economy.
Well, that's a whole lot of if-then statements,
It
but
is. It is. To your point, I'm trying not to hold too tightly to any one
I
outcome
know,
here.
but think about what you're saying. If this and this happens over the next couple of quarters, well, if we go through the next couple of quarters and you start to see that happening, then you have to start to plan on what you're going to do about it. But you
Hmm.
don't want to you don't want to do something now because you think in a couple of quarters this may happen, right? That's what I'm trying to say is that you have to have yourself set up for the risks that exist. However, you also have to be aware of the fact that uh, any adjustment or any major price decline in the market requires these group of variables to change, as we've talked about.
Yep.
And if a couple of months from now or a couple of quarters from now, it turns out that the data was weak enough to impact the employment and therefore the passive bid, you'll see it as it starts to happen, and you can start to react then. I mean, I'm not saying you should own 100%, be 100% in equities and then try to run out the door at the last minute. I'm just saying I'm not going to get myself all worked up about protecting myself on the downside any more than I already am by my setup. I'm not going to take any defensive measures to hedge a lot or to try to get short net short or anything like that until I see some sort of change. I can have less risk now overall just because of the things we've talked about, but that doesn't mean can want to do anything extra about it until I start to see something happening where things are changing.
Got it. Okay. So let me see if I can summarize that. You're saying Look, it's such an uncertain time for all the reasons we've been talking about that you have, let's say, partially de-risked your position, and you're sitting here kind of in this middle ground, and you're not going to really change all that much until the data proves to you one way or the other which
Yeah.
way it's heading.
Yeah, yeah. I mean, because if you have a healthy allocation of gold and gold miners, that protects you through a lot of this trouble. And if the scenario you talked about happens, if we get to that point, the stock market will decline. Maybe some of the miners go down with it. Maybe gold does for a time, but the response is going to be to pour more monetary stimulus on,
Right.
and that train ought to keep moving, right? It may be bumpy along the way, so I mean. So you may have to decide how to reduce your risk then, but I think you can set yourself up in a way that you have a chance to have you can pick businesses that can do well regardless of the environment, and then
Mhm.
if the market environment turns nasty, then you can try to hedge out the market risk. I guess that's what I'm saying.
Okay, got it. And specifically on gold and the miners, I totally understand the role they play in the portfolio for the reasons you just mentioned. I think a additional compelling reason to own them in the previous times you and I have talked, Bill, is they seemed, especially the miners, quite undervalued. You could make a real case that they were quite undervalued, even the miners relative to the metal. Now, we've finally had a really, bonanza year for the precious metals and the miners. Um, are you changing your allocation in any way because of how far and fast their prices have moved here?
Well, so two things. The price of gold itself is higher and therefore potentially riskier, even though and so that it's gold at 2,000 or 2,500 or 1,800 relative to the cost of production, which is the only real guide you have as is gold expensive or not.
Yep.
Um, it is certainly elevated, and the miners, while not expensive in general, um, aren't as depressed as they were.
Right. They're not
Um,
the screaming deals they were back when we were talking earlier.
no, no, but of course, anyone who's been around, watched the stock market. The stock market's been able to do quite well for 20 plus years, not being any kind of compelling value.
Yeah.
It's gone up because it's gone up for a lot of the reasons we've talked about in QE. So the hard part is, especially if you've been around these miners for a long time, they were like the redheaded stepchildren all the time, right? And so people are scared of their own shadow in the sector. And but meanwhile, some of the better ones now have like if you look at AEM or Alamos Gold, they're two of the best positioned that have any kind of market capitalization, especially AEM. And now they're 18 to 22 times depending on what you think the estimate's going to be. But in order to have a good estimate, you need to know where the price of gold's going to be next year. And of course, we don't
Mhm.
know that. So trying to figure out what the earnings are going to be is difficult. But you can look at where they've been, and now they're not priced way out of line relative to the S&P. I mean, we could talk a couple of multiple points either way. So some of them have gotten like Alamos and AEM are two of the very best managed and best positioned, and they have some size. Um, some of the smaller ones, there's a lot of mediocrity in the industry. It's a tough business. And so there's a lot of mines that either have low grades, are in bad places, or in the past would have bad balance sheets or only mediocre management. And I don't particularly care to own those. I don't want to own one where I got to worry about what the government where they are might cause a
Right.
problem.
Yep.
So the companies that I own are all in Canada, North America, or maybe a smidgen in Mexico. Um, and but there's some that are still quite cheap, and some of the other ones have short reserve lives too. That's another problem.
Hmm.
In any case, so they're not so before we had gold at a price it didn't seem like it had gone up all that much. In hindsight, we know that it didn't go up all that much, but at the time it seemed like it had a lot of room to go on the upside. Not
Yep.
And the valuation of the miners was depressed vis-a-vis whatever a market valuation is. Now, I'm not saying the market valuation is right, but you got to pick some yardstick. Um, so in any case, the problem with mining is so many of the analysts do this lame um, analysis where they look at what they call the net asset value. But the net asset value is going to be a function of what you're going to find in the property. And in some mines, if they're deep underground mines, you don't know till you get down there and drill. So the exploration drilling to prove up reserves always lags. So the NAV is a bad thing to look at. But
Hmm.
it's the lazy thing that people do tend to look at. You could take a look at a company like Wesdome, who people argue, which is another stock I own. Well, I mean, it's a Canadian valuate. It's trading for like $19, and based on where gold is, they may make around the estimate is like 240 for next year. So it's like less than 8 times earnings. They have two fantastic mines and with great growth opportunities, but they've had a couple of operational issues along the way, so people don't quite give them the love that they should get. Happens in the industry all the time. I used to have a big position in New Gold, and you couldn't give that thing away. And I've since sold mine because I don't like the length of their reserves. But now people are reacting to the fact that it seems so cheap. Whereas a year or two ago, you could have told people it was cheap based on an, what they could earn, and no one cared. So
Right.
there's been more sorting out. There's more people looking into the sector, but there still is not a lot of North American demand. There hasn't been for gold. If you look at the GLD shares outstanding is up this year. I think maybe 20%, but it's still down. It will need to go up another 35% to get to the peak of where it was in 11 or even
Hmm.
in 20 in COVID. So the move in gold has been by central banks and Asians more than Americans. So we haven't really even seen Americans get involved. Now, what's that going to take? I don't know. Is it going to is Trump going to have to get all four of his people on the Fed? I mean, I'm assuming Lisa Cook is going to be gone. I mean, the the drivers for gold look to want to push the price higher. The problem with gold is nobody knows what the price is supposed to be. Nobody. I mean, how would you? It doesn't matter if I don't care if you're the CEO of Agnico or any other mining company. You don't know. Nobody knows.
Right.
It's
It's the same issue Bitcoin has. I mean, nobody knows what true value is. Yeah.
yeah, where's it supposed to trade? If you can get the direction right, you're doing quite well, right? So while gold's gone up a lot, and now today it's up $50, but that's back in the old days, or back in the early days of this bull market, a percentage gain like today would have been $5. I mean, would you
Right.
if a $300 asset was up $5, would you think it was outlandish? So today it's 50. Well, I mean, it's like when Bitcoin goes up 1,000, that's just 1%, right? So sometimes the size of the numbers get people confused about how speculative it is when they don't look at the percentage gains.
Yeah. All right. So thank you for giving such a detailed answer. You anticipated a lot of the questions I was going to ask you. I am going to go back to my original question to you on this, though, which is I'm presuming, Bill, given your portfolio allocation where it was last time we talked versus now, gold and the miners occupy a notably larger percentage of it because they've really appreciated. Are
Well,
you changing that allocation in any way, or are you just letting it ride?
I reduced it earlier this year already because I had so much exposure. So I cut it back to what's still a giant amount, but it's not as big as it was.
Hmm.
And I'm lucky a couple of the other things that I've been involved in have done all right as well. So, I don't feel like I have to jigger things around much.
Okay. Okay. Good. No, that was kind of more I was going. If you had said, "Hey, look, I think it's made the majority of its run, at least for the near term, and I'm cutting it in
I
half,
don't,
and I'll buy
I
back
don't,
later
no, no,
on."
no, no, no,
Yeah.
no, no. I don't try to trade it. I mean, I think you're lucky to get the trend right. I don't try to trade small swings. If I thought something big was happening, maybe sometimes I have investing positions and trading positions. I only have one trading position right now, so I only have one that I would let go. So I'm and so I'm not, I don't try to trade to make money. I trade to not lose money. In other words, I trade defensively. So I try to let things run as they will, whether they're longs or shorts, and then only trade when I think I have to, not to try to trade to make money incrementally. So if I get the analysis right and the things go in the direction I want, that's how I'm going to make the money, not from trading the squiggles along the way. I trade the squiggles to try to reduce my risk along the way. That's
Okay, so your trades are mostly hedges, is what you're saying.
defensive. I would say defensive, not necessarily hedges, defensive.
Okay, defensive. Okay. All right. Well, look, you mentioned this a little bit earlier, but I'd like to pull on the string a little bit more on how you think the bond market may react going forward from here if things play out the way you think they will. Last time you and I talked, uh, I think the hero quote from that conversation was you saying you expected bonds to, quote, remain problematic for a good time to come. Don't want to put words in your mouth, but it sounds like you're still in that camp.
Yeah, I mean, recently, long rates now have come down a little bit. Longer rates have come down a little bit, um, thanks to some of the weak data we've seen. Um, Again, nothing really matters until we get to the FOMC meeting and see how the bond market reacts to that.
Hmm.
My belief, as I've stated, is I think longer rates will rise. If I somewhere around that, I'm going to get short bonds and see if it works out. Whether I get chased out and lose money or whether I make money, we'll have to see. But my plan is to get short bonds around the FOMC meeting or notes or so. I'm not sure exactly what I'm going to do, 10s, 20, 10s or longer dated paper. But my plan is to get short bonds, put some money behind my thesis. If it starts to work, I'll get bigger. If it doesn't, I'll throw in the towel.
Okay. And just to let folks know, the FOMC meeting is the 16th and 17th of this month. 17th is a Wednesday, and that's what, like a week and a half from now, Bill? So it won't be all that
Yeah.
long before we know the
No.
answer to this.
Right. And then
Yeah.
we'll see if there's something to do or not. And boy, if the bond market likes what the Fed does, I imagine the stock market will too, but we'll see.
Yeah. Okay. Well, yeah, I do wonder, I mean, at this point, the stock market is definitely bought in for a 25% basis point cut. If the Fed delivered a 50 basis point cut, I don't know if that would delight the market or freak it out. Do you have an opinion?
They're delighted. Now, the people that say that this line of logic, um, oh, the Fed surprises, they cut extra. What do they know that we don't? Must be terrible. Oh, it's bad. Sell stocks. That line of logic will get you killed. The Fed doesn't know anything. They're always late to everything.
Right.
On that point, Trump happens to be correct. That the Fed's always late, regardless of what it is. So if they cut 50 basis points, they cut 50 basis points. Believe me, the stock market's not going to freak out if that happens. I mean, maybe they'll sell it for 2 days, but then they'll come back and it'll get bought twice as hard. The only way the market's going to be allowed to freak out on that is if somehow between now and then the employment data has shifted enough to where then the passive bid changes.
Yeah.
Otherwise, lower rates are going to be deemed bullish, and the people that think that uh, that you're supposed to buy stocks every day are going to continue to think that.
Okay. All right. Well, let me ask you this. So I've interviewed a number of housing experts on this channel recently, and I always like to ask them when they're on about the demographic wave that we're about to face, with the baby boomers getting older. And in the case of housing stock, at some point in time, just as we've had for the past 20 years, 10,000 baby boomers hitting retirement age every day, at some point that's going to start turning into 20,000 or 10,000 baby boomers a day having to sell their home because they're going to the nursing home or they've passed away. Before we get to that, or at least before we get to that in earnest, um, we have a lot of baby boomers now that are retired and have been retired for a good while. At what point does the baby boomers withdrawals from their retirement accounts start putting enough selling pressure into the market that it does start to overwhelm the passive bid? And when that happens, are we looking at like a decade plus long period, 2 decade long period of just headwinds pushing against the passive capital flow?
Well, well, for I would hesitate to extrapolate anything that far, but again, if people, if the dynamic of people that are retiring, take their retirement money and start reducing the equity component, if that is enough to tip the passive bid, that will matter. Exactly where those levels are, I don't know. You'd
I don't
have
think
to ask
anybody knows.
Mike, if anyone knows, Mike knows, you know, so you'd have to ask him. But if housing gets sold and housing prices come down, that's good for younger people. I mean, I don't. Again, we're talking about analyzing the fundamentals of the economy and the market as though fundamentals were the drivers, and they aren't. They aren't the drivers anymore. They're a secondary effect. Sorry, they're a coincident variable that matters and helps push data around that the markets react to. But that's not the market is not S&P is not at 6,500 because of the fundamentals. No
Yeah.
chance.
No, I totally agree. I'm with
It's,
you on it's much more of
so
a voting machine than a weighing
so
machine now.
what
But
I
but but
just
but but all that matters, right, is passive capital flows. It's what happens with them, right?
right, and we keep going around and around on the same subject. And what everyone wants to know is when's that going to change?
I don't know when, and just I'm not asking you that question. I'm
No,
just
I
saying,
know that.
will it change?
I know I know that, but in some
Yeah,
ways we're talking about how many angels can dance on the head of a pin because we're talking about something that is not knowable, not calculatable, right? We know the factors at work. If okay, if all of a sudden employment was shrinking at a rate of 3% annualized, I'm pretty sure that would tip. Then the market would go south. And then that would make some of the people who have been riding along that have retired that were over allocated equities, they might sell theirs. So you could have a nasty fee. I could paint you a super bearish case really
yep,
fast, and it could get out of control very fast. So the reason I talk about all these things is so people understand what the dynamics are at work, what it takes to change them, if it's possible to know in advance, and yet you can't do much about it. You can have a plan. You can know about, okay, I want to be set up in a certain way, so I have to figure out some aspect of this. But the negative outcome is going to be horrendous. But that doesn't, I could have said that to you 2 years ago,
right,
that
right.
the
And
negative, and it still will be horrendous. And the longer this goes on, the more horrendous it will
it'll
be.
be, yeah.
But I don't want to get focused on that. That's why I don't want to. I mean, yes, housing may get weak. Will it matter enough? I don't know. Is it a good thing? Well, for some people it is, and some people it isn't, right?
Right. And sorry, and look, I think we see things real similar. The only thing I'm trying to do is when I was poking you earlier around this, it was more short-term outlook oriented, like next 6 months, next year. This question is just a finger to the wind, next couple
Right.
decades. Do we think that the aging out of the baby boomers may impact
Yeah.
the passive capital
Yeah.
flow to drive the
Yeah.
bus the way that it has to
Yeah.
date?
Yeah. 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 It will. And I'm not arguing with you, and I don't sense you're arguing with me.
Yeah.
What I'm
I'm
trying
not,
to
I'm not even making a case. I'm just
yeah,
simply asking you the
no, well, yeah,
question. Yeah.
but your listeners are like most people are trying to figure out, well, what am I supposed to take away from this? What actually matters?
Yep.
And it's very hard to do that because all of the things that really matter to economies and the stock market are pretty much tipping negative, except for monetary policy, which of course has been wrong for the better part of 30 years at most junctures, right? So, if we just looked at this as from a purely fundamental perspective, we get very bearish, and especially if we looked at valuations.
Right.
But none of that matters. So you have to know what the real story is, but then you have to know if it's gonna matter. And for right now, it doesn't matter. So the thing is, you have to know what really matters and when it matters.
Got it. And
And
I think it's a really good way to encapsulate it. And what I like about that, Bill, is um, in some ways it's sort of like what are the things we can have control over and not have control over. And like one of the things that I think you think really matters, regardless of the current situation that we're in, as to how long these passive capital flows continue or not, is you don't let me put words in your mouth here, but I think you believe that the purchasing power of our fiat money is going to continue to erode, which is one of the reasons why you hold on to
Correct.
the precious metals, right?
Correct. Correct. And that doesn't mean it's going to erode at the same amount all the time.
Right.
And I really believe part of the move, like let's say in the last few years, as gold's gone from, let's call it like the high teens, like 1800. So I'd say it's gone from the high teens to 3,500.
Hmm.
I think some of that is catch up from what it didn't do along the way, if that makes any
No,
sense.
I agree. I think it's price discovery entering in. People are
Yeah,
like, you know
yeah,
what, we underpriced this. Yeah.
yeah, because everyone was looking in the rearview mirror and saying, this there was a lot there was more inflation over from say 2000 to 2020 than the market really priced in because people hadn't felt like inflation got out of control. They weren't really worried about it. The stock market kept going up. So some part of gold's move is reacting to what I believe it's catching up to where it maybe should have been.
Hmm.
So all of this isn't necessarily about the future. It's okay, now we've repriced it for the environment we were in. For a long time, we didn't believe we were in that environment. We thought we'd go back to the old one. So now
Yep.
we've had a repricing. Now, where does it go from here? I think the pressures are still going to be to the upside because again, if you look at, we're all aware of the negative factors that work in America in terms of out of control national debt and deficit and other things but other countries are in the same boat. I mean, you want to be along the pound? How about the euro? You want to be along the renminbi? Maybe we could be along the yen if they could act, if they could just be men and raise rates over there a little bit. They kind of won the QE battle. They monetized half their debt. I mean, I think we're gonna try to do that here too. So there aren't good color papers, good choices of colored paper. Everyone's all in the same boat. So if you're going to try to hedge yourself, you say, well, I never really liked gold, but as a currency, it seems to have been working, right? It's the other reason why one of the reasons Bitcoin's done what it's done.
Yep.
So um, I just think the pressures are going to be to cause people to need to own gold that don't own any, or people that don't have enough to add more. The news events are going to tend to drive that in that direction, I think, at least as we look out at, a year and a half.
All right. Look, Bill, thank you for being so generous and as specific in the way you're looking at the world here. Really, very much appreciate it. I know we're coming up in the hour, so I'll start landing the plane here. Here's the last big question. Um, Earlier, you referenced that you could see the Fed, not only aggressively bringing interest rates down, but maybe eventually go into some sort of yield curve control, especially if the current administration is able to kind of stack the deck there at the FOMC. You just talk a little bit about yield curve control, just for the few folks that don't know what it is, explain it real quick, but also what would you expect to happen if the Fed did indeed start being aggressive on implementing it?
Well, what yield curve control is the Fed sets short-term rates, and but longer-term rates can kind of go where they want to, right?
They're set by the bond market. Yeah.
Yeah, by the market for the most part. I mean, not totally, but anyway, the yield curve control is where the Fed comes in and says, okay, 10-year rates are not going to trade above 350. We're going to the Fed's going to monetize as many as needed to hold the 10-year at 350 or the 7-year or whatever tenor they pick at whatever rate they pick. They will do QE, but they're not doing QE to help the economy. They're doing QE to buy bonds to hold the interest rates at a certain place. Now, you can imagine if you do that into a bond market that doesn't trust you in the first place, what's that outlet going to be? Well, I think the price of gold would go crazy, right?
Yeah.
Because we are the world's reserve currency, and so with that risk out there, how can you not want to own gold or miners or some combination? Because I think that I don't see how the U.S. government can get past the massive financing needs we have. When Trump first came in, we talked in January, February, there was some chance that maybe Doge was going to be able to pull off the miracle cure and cut enough, to maybe bring the deficit down in a meaningful way, or sort of, and then we could grow our way past it. Well, it's not playing out that way.
Yeah.
And I think that I mean, Bessent is a very smart guy. I suspect he's going to end up doing things that he would prefer not to do, because he's going to say, well, we can either let it collapse, or we can try to grow it hot and we'll anesthetize the bond market via yield curve control for a few years, and at the end it won't be that bad. See, the Japanese did it.
Hmm.
I mean, they'll try to sell it that way somehow.
Yeah.
And we'll have to see how it plays out. My bias is that it will make the metals go crazy, but we'll see, right? Maybe stocks will do fine. Maybe they won't. I don't know. I could argue both cases, because it depends on the passive bid. But we can wait to see when we get there.
Okay, and I'm just curious, and look, I'm asking you to prognosticate here, so folks, Bill's just doing his best guess. Um, Obviously, they'll go after the 10-year because that's so many things are priced off of that. Uh, what do you think they'll do with the long end of the curve, the
Oh,
30-year? Just let it be damned, or do you think they'll have to
no,
do some more too?
I'm making up so much. I'm making up so many things here. I mean, I don't know. Maybe they'll buy tens and twenties. I mean, I don't know. Maybe they'll let the 20. Maybe they'll let the really long stuff go, thinking, the market can handle that, but we're gonna keep everything. So maybe the yield curve, won't be a curve; it'll be a step function. I
Yeah,
I don't know, because a lot else. I mean, probably if that's happening, maybe the economy is weaker. If the stock market gets weak, there's so many things are going to play into that. I'm just sketching out a roadmap, and we'll have to see. You have to be able to hold a lot of thoughts and scenarios in your head at the same time when we're in the world we're in right now. You have to know the market's a joke, but it may go a lot higher still. You have to know that the Fed's doing the wrong thing and the bond market's trying to revolt. Maybe it will, maybe it won't. And then then we've got all these other wild cards. So it's a tricky environment. If you looked at the stock market, you wouldn't have any idea it was a tricky environment, and we know why that is.
yeah.
The damn passive bid. So it is not a market that is conducive to analysis in the short run.
Okay. And folks, just to underscore, this is why in the past I have brought up the what's happening in the employment market and what's happening with the unemployment rate. And just full disclosure, we'll likely continue to do that, maybe even more so in the near term going forward, just because we're starting to really see some weakness there in the jobs market. Because as goes the unemployment rate, that's basically the thing that impacts most the potential of where passive capital flows may go. So, to Bill's point that has been hammering through this whole video here is that the capital passive flow is in charge. And until and unless that's not the case going forward, we can prognosticate all day long, but it's not really going to matter.
See there, you condensed an hour conversation into 3 minutes.
All right. Well, look, Bill, like I said, it's always such a pleasure talking to you. Thank you for giving us so much time. I made a brief reference to your newsletter earlier on, but for folks that would like to get more Fleckenstein in between now and your next appearance on this channel, where should they go?
My website is fleckensteincapital.com, and I'm on Twitter at FleckCap, if anyone cares.
I'm sure they do, Bill. When I edit this, I will put up the links on the screen here so folks know
Okay.
exactly where to
Okay.
go. Folks, the links will be in the description below this video as well. All right. Well, in wrapping up here, folks, please tell Bill how much you appreciate him being on here today by hitting that like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you would like to get some professional help in terms of figuring out how to potentially position your portfolio for this really kind of uncertain time that Bill has told us about, and maybe potentially take a page from Bill's book about trying to find ways to position your portfolio so that you're a little less exposed to what exactly happens with passive capital flows. I highly recommend that most of the people watching this video, unless you've got a really good DIY track record of investing in periods like this before, that you get that help from a good professional financial advisor, and importantly, one that understands and takes into account all the macro issues that Bill has laid out for us here. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion of one who does meet that criteria, consider scheduling a free consultation with one of the financial advisory firms endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To schedule one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment to work with these firms. It's just a free service they offer to help as many people as possible. Lastly, we are still offering tickets for the Thoughtful Money Fall Online Conference at the lowest early bird discount price. A reminder that conference is going to be on Saturday, October 18th. And don't worry if you can't watch live. Everybody who registers will get sent replay videos of the whole conference, all the presentations, all the live Q&A sessions, including the transcript of the live chat that runs throughout the whole day. So if you haven't bought your tickets yet, make sure you run, not walk at this point, and go buy them at thoughtfulmoney.com/conference. And again, another reminder, if you are a premium subscriber to the Thoughtful Money Substack, make sure you use the code that I've emailed you to get an additional $50 off of that low early bird price discount. Bill, as usual, it's just such a pleasure. Thanks for giving us so much of your time today and really digging into the so what, like what really matters about all this. Very much appreciate you being so generous and really look forward to having you back on this program again soon in the future.
Sure thing, Adam. It's fun.
All right. And everybody else, thanks so much for watching.